right, welcome to the show.
Welcome to the show, October 6th, 2024. All right. Conan's a little under the weather, so I'm going to do the most of the talking on the show here. I got one piece that he's going to want to, I think, interject in on, and we'll get to that when we get to it. It's been a very busy week, so we'll just kind of jump into it. What we're going to talk about is what happened this week. September, performance in September on average historically versus what happened in September of 2024. It's pretty interesting. We'll take a look at the long-term trend, which we do with monthly candlesticks. We got a solution for the iFund. We talked about on last weekend's show. The iFund changed the index that it follows, and there's no ticker symbol for it. So we came up with a solution for that, and then we'll get to the TSP charts. All right, so what happened this week? From the macroeconomic perspective, a huge expansion in the war in the Middle East. That generated a big uptick in crude oil prices and a big uptick in the dollar, which is continuing through Friday here. It's Friday morning, about 10:30. We had the first major port strike since 1977. It got suspended as of Thursday night. I think it got extended to January 19th, which is pretty genius, I think, timing-wise for the Longshoremen's Union to strike right before the election. Pretty smart. You got Hurricane Helene and the after effects of that. So all those are bad, right? All those are really should put a serious strain on the stock market. You got a monster Chinese stock market rally that started last week that's continuing this week, and the S&P 500 barely moved. We'll see what happens by the end of the close today, but I think for the week we finished pretty flat, which is amazing. Okay. So in terms of the economic news for the week, you got Chicago PMIs, the Purchasing Managers Index, was up a little bit from 46.1 to 46.6. Anything below 50 is contractionary, right? So you want the Chicago PMI to be above 50. And the S&P was up on Monday, 0.42% for the day. So this is what the Chicago PMI chart kind of looks like. I did the max view. It's a barometer. You know, it edged up in September a little bit from August. The barometers remained in contractionary territory for the past 24 months. So what they're talking about is right here. It's been below 50, minus that one spike. It's been below 50 for about 2 years. So the economy is basically in this kind of contraction mode. You get order backlogs and employment improved slightly, while supplier deliveries, new orders, production reduced further. Also, prices paid remained elevated for the second consecutive month. So some downward pressure in terms of the PMI. You got, on Tuesday, we had the JOLTS, is the Job Opening and Labor Turnover Survey. It rose to 8 million, 8 million from an upwardly revised 7.7 million. So I can't remember what the number originally was in July, but it had been revised upward to 7.7, and it went up again this month. So labor market is easing, right, which is potentially inflationary, which makes it more difficult for the Fed to continue to lower rates. So the big question in the Fed right now is whether or not we get another 50 basis point rate cut in, I can't remember if it's October or November, the next Fed meeting. So anything inflationary makes it difficult for the Fed to do a 50 basis point cut. So on Tuesday, S&P is down almost 1%. Then on Wednesday, you get the MBA 30-year mortgage rate up. It was 6.13 last month. It's up to 6.14. And mortgage applications fell to a negative 1.3% from 11% last month. So a little bit of pressure on mortgage rates. ADP employment. So this is what ADP, not the government. The government numbers came out Friday morning, but the ADP numbers came out on Wednesday, and they're saying there was 143,000 jobs added versus 103,000 last month, and way above the forecast of 90,000. So that's good for the economy, right? People are getting jobs. but it's again inflationary, and so makes it more likely that we get a 25 basis point versus a 50 basis point cut at the next Fed meeting. S&P's down about 0.25% on Wednesday. Thursday, you get initial jobless claims at 225,000 versus 220,000 forecasts. Not that big of a deal. But any uptick in unemployment improves the odds that the Fed can do a more of a rate cut, right? So S&P is down 0.17%. So this all leads to Friday morning, which is a highly anticipated jobs number. Unemployment rate fell to 4.1% from 4.2, right? And it was expected to be 4.3. Okay, so the expectation was that unemployment was going to go up, but it actually went down. Non-farm payrolls, so the new jobs is the government's version of the ADP employment numbers, right? The government's numbers, non-farm payrolls are up 223,000 versus 114,000 last month, and they only expected 125,000 this month. So way more employment happening. Okay, a lot more people got hired this month than they expected. So the economy is definitely strengthening. And in the morning, the futures were way up. For the first hour or so of trading, the market was up. It's kind of pulling back a little bit now, so we'll see how it closes for the day. And ADP, so you can kind of see huge move up in payroll, right? Which is a good thing. Good thing for the economy. Okay. All right, so September historically. We put up this chart before. We're going back 10 years. Okay, so over the last 10 years, the month of September, this is the percent of months where the S&P closes higher than it opens. Okay, so over the past 10 years, September has only closed higher than it has opened 40% of the time. Okay, so less than half of the time. And it has an average loss of 2% for the month. Okay, that's the 10-year average. So another way of looking at that is this chart. I went back to 2014, so the last 10 years, and all the circles are all in September. Okay. So this month September of this year, we had a 2.02% gain, right, versus an average loss of 2%. So it was much, much stronger than the historical average. If you look at the chart, I thought this was really kind of fascinating. Here's 2024, okay? We only have one down month so far this year. Now this red tick right here is the month that we're in right now, so don't, obviously it hasn't finished yet, so don't count that. We got one down month so far in 2024. I went all the way back to find a year that only had one down month in the whole year. Now we still got 3 months to go, so we'll see, but I had to go back to 1958 to find a year when the last time we only had one down month in a year. It's unbelievable with all the recession concerns and everything else, the strength of the market, especially at this point in the year. I mean, September, again, it's supposed to be historically the worst month, and we got a 2.02% gain for September. So pretty unbelievable. So if you're looking at the chart, what does it really tell you about what you can expect going forward? The idea is that when you have a down September, October can go either way, but November and December historically are really strong. And sometimes that's true. Sometimes it's not true. You were looking for patterns that we can use to make reallocation decisions, and I don't like looking at I don't like making reallocation decisions based on historical patterns because anything can happen in the month that you're in. So if you looked at these circles, I mean, there's no guarantees that just because you have like a down month in September, you had an up month, an up October. There's no guarantees you get that every time, So take it for what it's worth. I prefer to respond to what the market is actually doing with the backdrop of the idea of what historically happens, if that makes sense. All right, so what is the actual long-term trend? We do that by looking at the monthly candlestick. So this is monthly going back to this is the bottom of 2009. One way to kind of play this, if you're a long-term TSP investor and you really only want to manage your money, let's say once a month, one way you can do it is to do a 5-month moving average and a 20-month moving average. So the 5-month is the black line. The 20-month is the blue line. And so when they cross, you're not going to get the exact tops and bottoms, but when the black line crosses down through the blue line, it tends to continue in that direction. When it crosses back up through the blue line, it tends to continue in that direction. So since the bottom in 2009, if you're looking at a monthly chart, you would have sold, right, or protected your gains there by going to the G fund in 2008 at that crossover. You would have gotten back in 2010 at that crossover, and you'd stayed in until 2022, right? So you would have avoided that drawdown in 2008, the little bit we had in 2022, but for the most part, you're in the whole time, and you're still in, obviously. The big takeaway from this is the long-term uptrend is definitely still in place. There's nothing here that says that on a big scale, the market's rolling over. S fund, you can do the same kind of thing. It's just a little bit more volatile on the S fund. We got a few more reallocation possibilities in the S fund just because it's more volatile, but you could do the same kind of idea. And the I fund's even more volatile. You'd really have to kind of be on it you'd be better off with a weekly chart of the I fund for sure. And the F fund we're going to get to a little bit more later, but it's pretty interesting. This was a huge, F fund had been in a slow, steady incline. And then when the Fed really started dropping rates, the bond market, we had some countries doing negative interest rates. And so when rates go down, the price of bonds goes up, and we had this big spike to a top in the F fund in, hold on a second. You good? Did you do that? Okay. We had a big spike to a top in the F fund right here, and then in 2021, and then once the Fed started a rate hiking cycle, right, when rates go up, price of bonds goes down. So we had this historic decline in the F fund, and then we've since had this recovery, which right now is questionable, and we're gonna get to that. Okay. So new I fund solution. This is the part that I want to have Conan talk about it if he wants to, but this is what the new I fund actually looks like with the actual numbers. You want to talk about that one?
Just how we did it?
Yeah.
Yeah, sorry guys, I got a big sinus infection going on, so I sound a little gravelly, or at least I feel like I sound gravelly. Yeah, so, big problem, not just for us, for everybody. There's no way to track the I fund now because the portfolio that they built, ex-US, ex-China, ex-Hong Kong, that fund doesn't exist anywhere else. We're the only one that has that. And so Morgan Stanley, the people that created that, haven't decided to give us a ticker symbol yet. Yep. I have faith that they will. I don't know how long it'll take, but I think if we pound our Congress people, they'll think, oh, this is a big deal. I don't know. So if you're the kind of person that's okay with sending your congressperson an email, I think now's a good time to do that because we need a ticker symbol so we can see the fund. So in place of that, there's always a way to manually build a chart. Yep. That's how they did it before we had all these fancy software programs. Yep. And so thankfully, stockcharts.com, something Jerry's been using for decades, I don't know, long time, long before we started using TradingView. We like TradingView for a lot of reasons. I love TradingView, so this isn't a knock on them. But they don't allow any external inputs. and so stockcharts.com does. And so what I did is a little, little geek work, basically, and just built the chart manually. Now it's all the closing prices for the iFund all the way back to its inception, right? Yep. So we have the iFund on a chart. And, if you're geeky enough, you could probably do the same thing. The simple version of that is you could do it in Excel. I mean, Excel has some ways to build a chart. Now, you couldn't lay indicators on that. I mean, you could technically if you know how to do all that stuff. But I'm not building that Excel file. So anyway, stock charts allowed us to be able to put this data in there, and it really is useful. And so until they come out with a ticker symbol, I mean, this is pretty much it. And it's okay because, although we talk about intraday prices a lot, they really don't matter. In the big picture, yep. You just need the closing day, and that's what we have here.
Yep. So the prices go all the way back. This is a chart basically of the last 4 years. We have the triple top we had talked about before. We got back above it. The way that the iFund, the data in the iFund includes dividend reinvestments. So this chart is a little bit different than like when we were using the Europe Asia Far East Index. The chart looks a little bit different than it does with dividends reinvested. So, but again, these are the actual iFund numbers. So if you go back,
that's actually this chart. Just by comparison, even though we like to use SPY. That's actually not the chart of the C fund.
Right.
Right.
SPX.
Yeah, or SPX, sorry. It's close. It's close enough to do what we do,
right.
But it's not exact. And so a lot of people, it takes a while for them to wrap their head around that. Well, this is exact.
This is the exact numbers.
If you go to TSP website, the numbers here, the prices will be exactly the same. Yep. If you calculate the returns, rates of return from this, you're going to get the same thing. So that's useful.
Yeah, it's definitely useful because I think a lot of people, I certainly would prefer to have charts that are of the actual TSP. It'd be great if there was a ticker symbol for the actual TSP fund that you could pull up in Stock Charts or TradingView, but it is what it is. They say that the goal of the C fund, for example, is to track the daily percentage moves of the index, which is the SPX. But while that's the goal, they don't, the actual returns would include dividend reinvestments. And so you can chart the SPY, which is going to be much closer to your actual C fund, because that SPY does include dividend reinvestments. SPX does not include the dividends, but they say that that's the goal of the C fund is to trade the daily move of the SPX. So this is a great solution for the iFund. It's a little bit clunkier on stock charts than it is on TradingView, but it's a good chart. Okay. So TSP fund charts. So very, very similar to what we've been talking about here for a while. This is as of the weekly chart as of like 10 o'clock. What time is it? 9:38 in the morning on Friday. So we'll see how that ends up, because we were down about 0.6%. We were down actually at the bottom of the week's trading range until the market gapped up this morning. So if it closes here, we'll be probably at a new all-time high. But even at that, you still have declining relative strength as prices moving higher, which just means, we saw the same thing at the top in 2022, right? Prices moving higher and relative strength is rolling over, and that's what led us to the 22 bear market. It can resolve to the upside. It's just that you need more momentum behind that price move. And right now, since this peak right here in July, as price has been continuing higher, momentum of that move has been decreasing. So it's just something to keep on your radar. S-Fund. S-Fund peaked back here in 2021. We're still, pretty significantly below that peak. But we've been moving in this kind of horizontal channel that we just kind of broke out of. We've been moving in that horizontal channel for a while. It builds up a lot of potential upside when it does that. So this is a tighter channel where we are right now, that rectangle. And if this price holds, for the week, we'll be back up, and we will have found support at that 5-week moving average line in the top of that channel. So that would be really solid for the S fund to continue higher. And I fund we talked about. This is the weekly chart. Weekly chart of the I fund. Had a big week last week. This week, not so much, down 2.37% so far. But again, that doesn't count Friday. So we won't get that probably until Monday morning, I guess, whenever the if the numbers update over the weekend, I'll get it in the newsletter. If they don't, the weekly close will be through Thursday. But again, you got the I fund price moving higher and relative strength, not as obvious as the C fund, but relative strength coming off. As long as relative strength continues to find support at that 50 RSI line, price can definitely keep going higher. And the F fund is the most interesting one, I think. So we definitely have a breakdown, right? We had the peak in the F fund back here. We got a 1, 2, 3, 4, 5 Elliott wave pattern to a bottom, which corresponded with the high in interest rates last year, right? And then as rates started coming down, the price of the F fund starts moving higher. So what's interesting is this peak right here in price was the day that the Fed began its rate cutting cycle. So you would expect that when they cut rates, price of bonds is supposed to go up when rates go down. Yes, but the F fund is dependent on the bond market, not on what the Fed funds rate does. So this is as of 9:40 this morning, because we had a big spike in yield last night. Big spike in yield, big spike in the dollar, and the F fund goes down. This is a problem, right? Relative strength broke through that moving average of the relative strength, so that's not good. Hopefully we find support here. If you're in the I fund, or the F fund rather, hopefully we find support at that 20-week moving average line. But what's interesting, what drives the F fund is the 10-year yield. 10-year yield peaks out in 1981, okay, at like roughly 17%. So it's been in a 40-year decline and bottomed finally in 2020, right? So when yield is going down, the F fund is going up. When yield goes up, the F fund goes down, right? The F fund went down during that big rise in yield. And right now, we're in this kind of, I would argue, is a topping phase, right? The expectation from there is that rates actually come down. That doesn't seem to be what's happening right now, right? And over the past couple of weeks, we had an uptick in rates. So just from looking at the perspective of this chart, you would at least expect rates to come down, if you had a big channel, like at least down to here somewhere before going higher. But if rates start moving higher again, especially if they get back above 5%, I mean, that's not good. That's like a stagflationary environment, right? Rates are going up. It would not be good. And so what does the F fund look like if you overlay it, right? When yield is coming down, the F fund is going up, right? When yield goes up, the F fund goes down. So it's much more, I mean, as much as everybody pays attention to the Fed cutting the Fed funds rate, what the 10-year yield does is what drives the F fund. And so this little uptick right here that you can barely see in yield is what's causing the F fund, that downtick in the F fund. So it's going to be really interesting to see. I find it very hard to believe that this little ABC correction that we had is going to correct this whole move up in yield. But we'll see what happens. Okay. Lots of stuff going on this week, and we still got the overhang of the election. And, seasonality history would tell you that November, December should be very strong, especially in election years. But we will see what happens. It doesn't always turn out that way.
All right, guys. If you have any questions, shoot them to us in the comment section wherever you found the video. And we will see you guys next week. Hope you guys have a good week.